Revenue share versus profit share. Which model is right for your independent brokerage? When it comes to growing an independent real estate brokerage, two incentive models often come into the conversation: revenue share and profit share. But which one is actually right for your brokerage? This isn't about which model sounds better to agents. It's about which model works better for you as a broker owner, from cost and administration to recruiting, retention, and long-term business growth. In this video, we'll break down the key difference between revenue share and profit share and help you understand which model fits your brokerage. Let's start by understanding what profit share actually means. What is profit share? Profit share distributes a portion of the brokerage's net profit to eligible agents. That means the brokerage first pays its operating expenses, such as staff, technology, marketing, rent, and other overhead costs. What remains after those expenses becomes the basis for the profit share pool. Payouts are commonly calculated periodically, such as quarterly or annually, and may consider factors such as production, tenure, and recruiting contribution. The key point is simple: profit share depends on the brokerage actually generating profit. Now, this brings us to the most important difference between the two models. The critical difference. Revenue share and profit share operate at different points in the brokerage revenue cycle. Revenue share is calculated from gross company dollar before operating expenses are deducted. Profit share is calculated from net profit after the brokerage's operating expenses have been paid. That difference has a direct impact on predictability. With revenue share, an agent's payout is connected to transactions generated by their recruited agents. With profit share, the payout can change depending on the brokerage's expenses and profitability. So what does this difference mean in practical terms for a broker owner? Broker owner comparison: revenue share versus profit share. Let's compare the two models across the areas that matter most to independent brokerages. Revenue share offers higher payout predictability because the calculation is tied to transactions rather than overall profitability. Profit share is more variable because the available pool depends on net profit. Revenue share is also less affected by decisions such as hiring staff, expanding technology, or increasing marketing spend. With profit share, those expenses directly affect the available profit pool. Revenue share also provides a more concrete recruiting message. You earn a defined percentage from transactions your recruits close. Profit share is more difficult to quantify because the final payout depends on the brokerage's profitability. But that doesn't mean profit share is the wrong choice. There are situations where it can be the better model. When profit share makes sense. Profit share can make sense for established brokerages with consistent and predictable profitability. If a brokerage has stable production and overhead over multiple years, agents may be able to rely on meaningful profit share payouts. It can also work well when a broker owner wants agents to become more invested in overhead discipline and the financial health of the brokerage. And finally, profit share can fit culture-first brokerages that already have a strong commitment to financial transparency. So, for mature and consistently profitable brokerages, profit share can create a strong ownership-oriented culture. Now let's look at where revenue share has a clear advantage. When revenue share makes sense, revenue share is particularly suited to independent brokerages that are still growing and building their profit margins. During a growth phase, a brokerage may be investing heavily in staff, technology, marketing, and recruiting. Under a profit share model, those investments can reduce or eliminate the available payout pool. Revenue share works differently. Agents can earn from qualifying transactions generated by their recruited agents, regardless of the brokerage's overhead decisions. Revenue share also gives broker owners a clearer recruiting proposition and a simpler administrative structure. So which model should most independent brokerages start with? The verdict: for most independent brokerages, revenue share is the stronger starting model. It is particularly well suited to brokerages with fewer than 100 agents, brokerages still building profitability, and owners who want a strong recruiting incentive without exposing internal financial performance. Profit share becomes more attractive when the brokerage has consistent multi-year profitability, is comfortable with financial transparency, and wants to build a deeper ownership culture. Ultimately, the deciding factor is the structural difference between gross and net. If profitability is still variable, revenue share provides greater predictability for agents and a more accessible model for broker owners. But choosing the model is only the first step. You also need to understand what implementation requires. Implementation reality. A revenue share program generally requires three core elements. First, a system to track who referred whom and the applicable structure. Second, a per-transaction payout calculation. And third, a clear program document explaining eligibility, payout percentages, and program conditions. Profit share requires a different infrastructure. You need accurate profit and loss reporting, a reconciliation and distribution process, and a commitment to financial transparency so agents understand how payouts are determined. Neither model is impossible to administer. But for broker owners without robust financial reporting infrastructure, revenue share is generally the more accessible starting point. Once you've selected your model, the next step is to evaluate its financial viability. What comes next? Choosing the right model should ultimately come down to your brokerage's numbers. Consider your agent count, production levels, growth targets, profitability, and recruiting goals. If revenue share is the direction you're considering, the next step is to model what the program could generate over year 1, year 2, and year 3. The goal isn't simply to offer an incentive. It's to build a program that supports recruiting, retention, and sustainable brokerage growth. Let's bring the comparison together in one final takeaway. Revenue share and profit share can both create meaningful incentives, but they serve different brokerage environments. Revenue share is generally the stronger starting point for growing independent brokerages that want predictable payouts, a strong recruiting message, and simpler administration. Profit share can be the stronger choice for established, consistently profitable brokerages that value financial transparency and deeper agent participation in the brokerage's financial success. The key difference is simple. Revenue share is based on gross company dollar. Profit share is based on net profit. Understand that difference, and you can make a much more informed decision about the model your brokerage should build. To learn more, read our blog. The link is in the video description.